the greatest investor who ever lived, just walked away from the table. Not because he lost, because he sees something the rest of us refuse to look at. On January 1st, 2026, Warren Buffett officially stepped down as CEO of Berkshire Hathaway. He handed the keys to Greg Abel. He said his goodbyes, and he left behind the largest pile of undeployed cash in the history of American finance. $382 billion, sitting in short-term treasury bills, earning a modest return, doing absolutely nothing. That is not retirement. That is a warning siren dressed in a cardigan. You need to understand what this means. This is not a 95-year-old man who got tired and went home. This is the Oracle of Omaha, the man who turned a dying textile mill into a trillion-dollar empire, telling you with his actions what he would never say with his mouth. The market is a trap, and he is not walking into it. For 13 consecutive quarters, Buffett has been a net seller of stocks. 13. That is over 3 years of selling more than he buys. He dumped 74% of his Apple position. He slashed his Bank of America stake by 50%. He offloaded Amazon by 77%. He sold billions in DaVita, Nucor, and D.R. Horton. And he replaced all of it with the most boring investment on the planet, United States Treasury bills. He now holds more T-bills than the Federal Reserve itself. Let that sink in. One man's company owns more short-term government debt than the central bank of the most powerful nation on earth. This is not a portfolio adjustment. This is a siege preparation. Buffett is filling the castle with supplies and pulling up the drawbridge. And you are standing outside the walls, wondering why the sky looks funny. Think about what Treasury bills actually are. They are the shortest-term, safest debt instrument the United States government issues. They mature in weeks or months, not years. They are the investment you choose when you want zero risk and maximum liquidity. You park money in T-bills when you believe the opportunity to buy something better is coming soon, and you want to be ready to move the second it arrives. And while Buffett sits in safety, retail investors are doing the exact opposite. Individual investor sentiment surveys show bullish readings near historic highs. Margin debt has ballooned as everyday people borrow money to buy stocks at the highest valuations in 150 years. Zero-day options trading has exploded, turning the stock market into a slot machine. People are buying lottery tickets and calling it investing. The contrast between what the smartest money in the world is doing and what the average person is doing has never been wider. That gap is not a coincidence. It is the trap. I track these signals in real time so you can see the pattern before it becomes a panic. Hit that subscribe button right now. I read every single comment because that is where the real pulse of this economy lives. Let me know below. Are you paying attention to what Buffett is doing, or are you still listening to what Wall Street is saying? Also, a quick shout out to my partner channel, Finance Unfold. Go follow them as we build an army of informed investors who refuse to be the last ones to know. Now let me show you why this matters more than any headline you have read this year. To understand Buffett's exit, you have to understand Buffett's language. He does not scream. He does not tweet warnings at midnight. He speaks with capital allocation. Every dollar he moves is a sentence. Every stock he sells is a paragraph. And what he has written over the last 3 years is a novel about danger. Start with the timeline. In late 2023, Buffett began trimming Apple. At the time, people thought it was routine. Maybe he was locking in profits. Maybe it was a tax strategy. But he did not stop. Quarter after quarter, the selling accelerated. By the end of 2025, he had reduced a position that was once worth $200 billion down to roughly $60 billion. He sold during a bull market. He sold while Apple was hitting all-time highs. He sold while every analyst on television was screaming buy. Then came Bank of America. Buffett saved that bank in 2011 with a $5 billion lifeline, when the aftershocks of the financial crisis nearly killed it. He made tens of billions on that trade. It was one of the most celebrated investments of his career. And he walked away from half of it without saying a single word about why. The financial media scrambled for explanations. They said it was about tax planning. They said it was about valuation. They said maybe he just wanted to leave Greg Abel a clean balance sheet. All of those explanations missed the point entirely. You do not sell $174 billion in equities over 30 months because of taxes. You do it because you believe what is coming next will give you a chance to buy those same assets for a fraction of the price. Think about who we are talking about. This is the man who said his favorite holding period is forever. This is the man who built his fortune by buying great companies and never letting go. When Warren Buffett sells, it is not because he is bored. It is because the math has broken, and the math has broken. Let me show you the specific numbers that are keeping Buffett on the sidelines. There is an indicator that bears his name. It is called the Buffett Indicator. It measures the total value of the United States stock market divided by the country's gross domestic product. Buffett himself once called it the best single measure of where valuations stand at any given moment. As of early 2026, that ratio is sitting at 230%. That is the highest reading in recorded history. It is roughly 75% above its historical average. It is more than 2 standard deviations above the trend line. To put that in plain English, the stock market is priced as if it is worth more than double the entire economic output of the United States. Every factory, every service, every paycheck, every transaction, double all of it, and the market still thinks it is worth more. That is not optimism, that is delusion. Now layer on the CAPE ratio. That is the cyclically adjusted price-to-earnings ratio developed by Nobel laureate Robert Shiller. It measures the price of the S&P 500 relative to the average inflation-adjusted earnings over the prior 10 years. As of this year, the CAPE ratio hit 40. The only other time in the last 150 years that it reached this level was during the peak of the dot-com bubble in 2000. You remember what happened next. The S&P 500 lost nearly 50% of its value over the following 2 years. Here is the data point that should make your blood run cold. According to historical analysis, the S&P 500 has never increased during the 3-year period after its monthly CAPE ratio topped 39. Never. Not once. Every single time the market reached this level of overvaluation, it declined over the subsequent 3 years. The average decline was 4% per year. The worst case was catastrophic. Buffett sees these numbers. He lives and breathes these numbers. And his response was not to hedge. It was not to rotate into defensive stocks. It was to leave. Completely. He converted the majority of his equity portfolio into treasury bills paying 4 to 5%, and he sat down. He chose a guaranteed modest return over the risk of a historic decline. Let me give you some historical context so this really sinks in. There have been only 3 other times in the last 60 years when valuations reached anything close to these levels. The first was the late 1960s. The market was euphoric. Everyone was making money. Then the 1970s arrived. Stagflation. The S&P 500 fell over 40% from peak to trough. It took until 1982 for investors to recover. That is more than a decade of lost wealth. The second was 2000, the dot-com bubble. Tech stocks were trading at insane multiples. Analysts said earnings did not matter anymore because the internet changed everything. The Nasdaq crashed 78%. The S&P fell nearly 50%. Trillions of dollars evaporated. People who retired in 2000 ran out of money before they ran out of years. The third was 2021 to 2022. The post-pandemic bubble, fueled by trillions in stimulus and zero interest rates. The market peaked and then corrected hard. The S&P dropped 25%. The Nasdaq fell over 30%. Crypto collapsed. Bonds and stocks fell together for the first time in decades. In every single one of those episodes, the valuation indicators looked exactly like they look right now. Overheated, stretched, disconnected from the underlying economy. And in every single case, the correction was brutal. Buffett was positioned correctly for all of them. He is positioning the same way now. This is the part most people miss. Buffett is not predicting a crash. He does not do that. He has said 1,000 times that nobody can predict the market in the short term. What he does is assess value. He asks one question: can I buy $1's worth of business for less than $1? And right now, the answer is no. Everywhere he looks, the price tag is higher than the value underneath it. But here is where Buffett's retirement intersects with something much bigger. Something that turns his quiet exit into a screaming alarm. If this is making sense, and you want more people to see the signal before the noise drowns it out, hit that like button right now. One click changes who the algorithm shows this to. This is information that could change how someone protects their family. Look at the world Buffett is walking away from. The national debt has blown past $36 trillion. The annual deficit is running at $2 trillion. Interest payments on that debt now exceed $1 trillion per year, more than the entire defense budget. The Federal Reserve is trapped between inflation that refuses to die and an economy addicted to cheap money. Tariffs are at their highest levels since 1946. The dollar has lost 9% of its value in the last 12 months. Foreign buyers of American debt are disappearing. China is dumping treasuries and buying gold. Japan is selling bonds to save its own currency. The petrodollar system is cracking, as Saudi Arabia accepts yuan for oil. The BRICS nations are building alternative payment systems that bypass the dollar entirely. Buffett watched all of this unfold from his office in Omaha, and his response was to stack $382 billion in the safest short-term instrument available and hand someone else the steering wheel. Think about what he said at his final shareholder meeting in May of 2025. When asked about tariffs, he said trade should not be a weapon. When asked about the market, he said, "We are running a business which is very, very, very opportunistic, and we have made a lot of money by not wanting to be fully invested at all times." When asked about the future, he said, "Things get extraordinarily attractive occasionally, and the long-term trend is up." Read between the lines. He is telling you this is not one of those occasions. He is telling you the extraordinary attractiveness is not here yet. He is telling you to wait. Now combine Buffett's positioning with what the other smart money is doing. BlackRock just rotated $2 trillion out of US-centric positions and into emerging markets and international equities. The largest asset manager on the planet is reducing its American exposure at the same time the greatest stock picker in history is sitting on a mountain of cash. These are not coincidences. These are signals. Massive, coordinated, screaming signals that something is fundamentally mispriced in the American financial system. And yet, retail investors are doing the exact opposite. They are buying the dip. They are leveraging into AI stocks. They are convinced that this time is different, that valuations do not matter because technology has changed the rules. That is exactly what they said in 1999. The only thing that changed was the size of the crater. Here is the tragedy of it. Most Americans have their entire net worth tied to two assets, their home and their retirement account. Both of those assets are priced at levels that assume nothing goes wrong for the next 10 years. The average 401k is stuffed with index funds that mechanically buy the S&P 500, regardless of price. These passive funds now control more money than active managers for the first time in history. That means trillions of dollars are being allocated based on market cap weight, not on value, not on earnings, not on any fundamental analysis at all. The biggest stocks get the most money simply because they are already the biggest. It is a self-reinforcing loop that pushes prices further and further from reality. And when the loop breaks, there is no fund manager making a judgment call to slow down the selling. The algorithm sells at the same speed it bought, indiscriminately, violently. Buffett has talked about this phenomenon for years. He has warned that passive investing works beautifully on the way up and becomes a wrecking ball on the way down. When everyone owns the same basket and everyone tries to exit the same basket at the same time, the door is not wide enough. The liquidity vanishes, the bids disappear, and the price discovery that used to happen through careful analysis now happens through panic. Let me walk you through the specific chain reaction that Buffett is positioning for. This is not speculation. This is mechanics. The same mechanics that have played out in every single market cycle for the last century. When valuations are stretched to historic extremes, they do not stay there. They revert. It is gravity. The higher the market climbs above fair value, the harder and faster it falls when the music stops. And the music always stops. The trigger could be anything. A failed treasury auction where nobody shows up to buy American debt. A credit event in commercial real estate where $2 trillion in loans come due and the buildings backing them are worth half what they were. A geopolitical shock in Taiwan or the Middle East that sends oil prices through the roof. A sudden spike in unemployment as the lagged effects of high interest rates finally crush small businesses. A cascading bank failure that starts at a regional lender and spreads like wildfire through the interconnected financial system. It does not matter what lights the fuse. What matters is that the building is made of dynamite. Every overvalued stock is a stick. Every leveraged position is a detonator. Every passive index fund that mechanically buys regardless of price is gasoline poured on the floor. And the fire exits are narrow. When the selling starts, it cascades. The same algorithms that pushed prices up on autopilot will push them down on autopilot. Margin calls will force liquidations. Liquidations will trigger more margin calls. The feedback loop is identical to every crash in history. The only variable is speed. And in 2026, with high-frequency trading and zero-day options and 24-hour crypto markets acting as pressure release valves, the speed will be unlike anything we have seen before. Buffett knows this. He lived through 1973. He lived through 1987. He lived through 2000. He lived through 2008. He lived through 2020. In every single case, the greatest buying opportunities of his career, came after the crowd was in maximum pain. He bought Wells Fargo during the savings and loan crisis. He saved Goldman Sachs during the financial collapse. He bought billions in equities during the pandemic crash when the S&P hit 2,300. And, in every single case, he had one thing the panicked sellers did not: cash. Massive, boring, sitting in T-bills, doing nothing, ready to deploy cash. That is what $382 billion represents. It is not a retirement gift. It is ammunition. It is the single largest war chest ever assembled by a private enterprise, positioned and waiting for the moment when fear is at maximum and prices are at minimum. The question you need to ask yourself is not whether Buffett is right. The question is what you are going to do about it. If you are sitting in an all-stock portfolio at the highest valuations in 150 years, you are making a very specific bet. You are betting that this time is different. You are betting that the gravity that has pulled down every overvalued market in history will somehow skip this one. You are betting against the man with the greatest track record in the history of investing. That is a bold bet, and it might work for a while. Markets can stay irrational longer than you can stay solvent. But Buffett is not trying to time the top. He is trying to be ready for the bottom, and the bottom always comes. Here is what you can learn from his playbook. First, cash is not trash. For years, financial influencers have told you that holding cash is losing money. They point to inflation. They point to opportunity cost. But Buffett just demonstrated that holding cash at the right time is the highest returning investment you can make. When the market drops 30 or 40% and you have dry powder, every dollar you held becomes $1.50 of purchasing power. Cash is optionality. It is the ability to act when everyone else is frozen. Right now, you can earn 4 to 5% in a high-yield savings account or a short-term treasury. That is not spectacular, but it is positive, and it keeps your capital intact for the moment when true bargains appear. Buffett once said the first rule of investing is never lose money. The second rule is never forget the first rule. Sitting in cash at the top of a market is not cowardice. Second, stop worshiping the price chart and start reading the balance sheet. The S&P 500 looks like it only goes up. That is an illusion created by a 14-year bull run juiced by zero interest rates and trillions in printed money. Underneath that chart, corporate debt has exploded. Stock buybacks funded by borrowing have artificially inflated earnings per share. Revenue growth has slowed, while price-to-earnings multiples have expanded. The chart looks healthy. The patient is sick. Third, pay attention to what institutions do, not what analysts say. CNBC can run 100 segments about why the bull market will continue. But when Berkshire Hathaway has been a net seller for 13 straight quarters and BlackRock is rotating trillions overseas, the actions are telling you a different story. Watch the hands, ignore the mouth. Fourth, geographic diversification is not optional anymore. Buffett himself made one of his biggest new investments in recent years, not in America, but in Japan. He bought stakes in 5 major Japanese trading houses. These are companies with low valuations, strong dividends, and exposure to global commodities. He saw value outside the United States when the domestic market offered none. Fifth, and this is the hardest one, you need to be emotionally prepared for a significant drawdown, not because it is guaranteed to happen tomorrow, but because the setup is identical to every previous era that preceded one. If you panic and sell at the bottom, you transfer your wealth to the person who stayed calm. Buffett has said it plainly. The stock market is a device for transferring money from the impatient to the patient. Decide now which side of that transfer you want to be on. And here is a final lesson that is worth more than any stock tip. Look at what Buffett did with his wealth. He has already given away stock, currently valued at $208 billion. He has directed his children to donate virtually all of the rest. The richest investor in history lives in the same house he bought in 1958 for $31,500. He drinks cherry Coke. He eats at the same steakhouse. He drives himself to work. The man who understood money better than anyone who has ever lived chose not to worship it. He chose to use it as a tool, not as an identity. And in his final act as CEO, he chose to protect it rather than gamble it. That tells you everything you need to know about where we are in the cycle. When the greatest risk taker in the history of capitalism decides the risk is not worth taking, you should listen. Not to his words, to his actions. The $382 billion sitting in treasury bills is the loudest action in the history of Wall Street. The Oracle of Omaha did not retire because he got old. He is still going to the office. He is still chairman of the board. He said he is going quiet, sort of. That sort of is doing a lot of heavy lifting. He is watching. He is waiting. And when the moment comes, when fear is thick and prices are thin, the $382 billion will move. It will move fast. It will move into assets that the rest of the world just finished panic selling. And the wealth transfer will be complete. This is what Buffett has done his entire life. He did it at 25 years old, buying stocks during the 1950s. He did it at 50, buying during the savings and loan crisis. He did it at 78, saving Wall Street in 2008. And now, at 95, he has set the table for the largest opportunistic deployment of capital in history. He just will not be the one pulling the trigger. Greg Abel will. But the ammunition is loaded. The strategy is clear. And the target is a market that has not yet fallen to earth. You have a choice right now. You can ignore the signal. You can tell yourself that a 95-year-old man sitting on cash just does not understand the new economy. You can keep buying at record valuations and hope the music never stops. Or you can do what Buffett does. You can assess the math. You can acknowledge that the price you pay determines the return you get. You can build a position of strength, not leverage. You can hold cash when nothing is cheap and deploy it when everything is. The man who turned $400 of childhood savings into $150 billion of personal wealth is telling you through every action he has taken for the last 3 years that the American stock market is not a place to put new money right now. He is not screaming. He is not making YouTube videos. He is simply sitting in T-bills and waiting. His silence is the loudest warning Wall Street has ever received. The wealth transfer is not a conspiracy theory. It is mathematics. When the market corrects from 230% of GDP back toward its historical average, trillions of dollars of perceived wealth will vanish. It will not be destroyed. It will be redistributed, from the people who bought the top to the people who held the cash, from the impatient to the patient, from the crowd to the prepared. This has happened in every major correction in history. In 2000, the people who held cash through the crash bought Amazon at $6. They bought Apple at pennies on the dollar. They built fortunes on the wreckage of other people's greed. In 2009, Buffett himself deployed billions into Goldman Sachs and General Electric at prices that made him a fortune within 2 years. In 2020, the people who had cash bought the S&P 500 at 2,300. It is now worth more than double that. The pattern is always the same. The cycle of greed pushes prices to absurd levels. The correction wipes out the over-leveraged. And the patient buyer with cash walks through the wreckage and picks up world-class assets at fire sale prices. Buffett has done this his entire career. He is setting up to do it one final time. The only question is whether you will be positioned alongside him or against him. Buffett just chose his side. The question is whether you will choose yours before the window closes. But knowing that the greatest investor alive is sitting in cash is only half the story. You need to know exactly where the first crack appears. There is a specific sector of the market that Buffett quietly exited that is now sitting on $2 trillion in debt that comes due over the next 18 months. When those loans mature, the defaults will cascade through the banking system and into your portfolio whether you own those stocks or not. I broke down the exact timeline, the 3 companies most at risk, and the defensive positioning that could protect your wealth in this video right here. Click it now. I will show you the chart that explains everything.